Interest rates have been dropping. Finally, after 2 years of just seeing interest rates climbing and then remaining at elevated levels, especially since the super low record-breaking pandemic rates that we had for a few years, we're finally seeing interest rates start to come down a little bit, which is a good sign. But in this episode, we're actually going to be talking about why many people are actually not going to be able to take advantage of the lower rates that we're seeing in the market. So there are 3 reasons why a lot of home buyers who've been waiting for this very thing, the drop in interest rates, are actually not going to be able to take advantage of those lower interest rates. First thing right off the bat is because they have not been saving up any money for down payment or closing costs. Down payment assistance is something that many people are relying on these days to be able to purchase a home. And while down payment assistance can do a lot to bridge that gap between where you are and the home that you want to be in, it does not cover the entire span of what needs to be covered in order for you to cover all of the cash to close that's needed in order for you to purchase that home. So 2 main things that you need in order to be able to purchase a home. There's the down payment and there's the closing cost in terms of upfront cost that you will have. So that down payment will cover that 3 or 3.5% that you need to be able to pay to get that conventional or FHA loan. But then for the remainder of the money that you need to pay, that's the closing cost, which is including your taxes, your insurance, your origination fees, any discount points that you have to pay, your attorney fees, your title fees. All of that is what I'm wrapping into closing costs, which also needs to be paid. And sometimes your closing costs could end up being another 3% or 2.5%, or depending upon who you go with or the purchase or where you're purchasing this property, it could be 3.5%. So your closing costs can vary, but in any case, that's going to be something that you need to save for. So even though down payment assistance does help to cover that gap, it does not provide the entire amount that you're going to need. And so many people's inability to be able to save the money that they need is what's going to prevent them from being able to take advantage of these decreasing interest rates that we're seeing. One thing that you can do to ensure that you are going to be saving the money that you need to save is called pay yourself first. When you get paid, you take the money that you get paid from your job and you pay your rent, you pay your car note. If you have a car note, you pay your cell phone bill, you pay utilities, you pay all these other bills. Add yourself to that list. There should be a set amount of money out of every single paycheck that goes to you. And that money should go to a savings account at the least, because a savings account is not really going to give you much return on your money, but at the least it should go to a savings account, if not going into some other investment vehicle that's actually going to be yielding you a much greater return, maybe a money market account or an insurance account, something that's going to yield you much greater return on your money, but at the least put it into a savings account. But what you want to do is make sure that you are paying yourself out of every single paycheck. Don't let the utility company and the gas company and your car note, or whoever the lender is for your car note, and your landlord and everyone else get a piece of your check, but you don't have any of your check designated for you. Your check, you might just spend it at Starbucks, you spend it on entertainment. Don't do that. Take a portion of your check and designate it just for you. And then whatever's left over, that's your discretionary funds. You can do whatever with it, what you want to do with it, but make sure that a piece of your check is paying you so that you're saving up for the long term. So that's the number 1 thing, not saving for down payment. The number 2 thing is, throughout that time that people have been waiting to be able to purchase a home, they've not been working on their credit. Interest rates could go down to 2%, but if your credit sucks, you're still not going to get approved for a home. So during that time when you've been waiting on interest rates to drop, you should have been working on your credit. And there's still time for you to work on your credit. So don't take this as a you missed the boat type of speech. You can still work on your credit now and still be able to purchase a home during the times when interest rates are still decreasing, because depending upon your situation, it might not take you a long time to repair your credit. It might take 3 months. It might take 1 month. It might take 6 months. But in any case, you have time. So get started now. Reach out to a loan officer and find out what it is that you need to do in order to start working on repairing your credit. And check the description as well, because I'm also going to put some information in the description to help you get started on that credit journey, because this is an area that I have a lot of expertise in, and I do guide a lot of people into the area that they need to go to get their credit where it needs to be so that they can purchase a home. So check the description. I'll put some more information in there. But ultimately, for this second bullet point, you want to make sure that you are working on your credit, because again, this is really, really, really important, not just for you being able to qualify for a home, but the credit is also the thing that can end up saving you thousands of dollars when you purchase that home, because it can get you access to lower interest rates. It can get you access to higher purchase prices at the same interest rate as someone else who might have a lower purchase price because their credit score is lower. But if you have a better credit score, you might be able to access a higher debt to income ratio, which actually might allow you to be able to purchase the home that you really want, which is currently out of your price range because of where your credit is. So credit has a huge impact on you being able to save thousands and save tens of thousands, even within the course of a year, or be able to purchase a more expensive home that you otherwise would not be able to afford. So work on that credit, because it is key in just the impact it's going to have on your home ownership journey. So the third and final reason that many people are not going to be able to take advantage of these decreasing interest rates is that they simply have too much debt. Debt to income ratio is a huge part of purchasing a home. And when you go to purchase a home, one of the things that the lender is going to check is they're going to pull your credit report, and they're going to take all the debts that are on your credit report. Then they're going to look at your pay stubs and your other and your W-2s as well, and they're going to see how much income you make, and they're going to subtract out how much debt you have, and from that they're going to make the determination on how much money is left over, and is that enough for you to qualify for a mortgage based on FHA guidelines, or based on Fannie Mae or Freddie Mac's underwriting guidelines, or based on VA if you're getting a VA loan. Whatever the guidelines are they're using, they're seeing if you have enough money left over to even qualify, because you can have an 800 credit score and you can have $20,000 in the bank, but if your debt to income ratio is too high, you're not going to qualify for that home. It doesn't matter if you have 20,000, 30,000 in the bank, and if you have an 800 credit score, your debt to income ratio still needs to line up with the mortgage underwriting guidelines in order for a mortgage lender to be able to approve you for that home loan. So start paying down some of those debts. And my recommendation is to start off with the credit cards, because those are the debts that you can pay at any time, and it's not going to hurt your credit score to pay off credit cards. Talk to a mortgage loan officer before you start paying off things like a car note or another installment loan if you've got a personal loan or something of that nature. Talk to a loan officer first before you pay those off, because if your credit is on the fringes or kind of, on the teetering on the edge of you being able to qualify, and then you not being able to qualify, paying off a car could tip you over that edge in terms of now you don't qualify for what you could have previously qualified for if you hadn't have paid off the car. And there are ways that mortgage lenders can structure it so that you pay off those cars or pay off whatever you might need to pay off at closing, and that way it does not affect your credit, and it also does not require as much paperwork throughout the loan process if you pay some things at closing vice paying them in advance as well. But the one thing that you can always pay in advance and is not going to hurt your credit score are your credit cards. And that's one thing that tends to hurt a lot of people as well, especially with their credit score, is that they have really high credit card debt. And so paying those credit cards down is going to help your debt to income ratio, but it's also going to help your credit. So there you go, 2 birds, 1 stone. Get those credit cards paid down. You're going to help out your credit score, and you're going to help your debt to income ratio. So those are the 3 things that I wanted to discuss just briefly in this episode, is that I don't want a lot of people to miss out on the opportunity that is coming up right now in the real estate industry. There's been a lot of stuff happening. You've been hearing about it. You've been probably reading about it. A lot of people by now know about the NAR lawsuit and settlement that has been happening. And You've seen just the fluctuation in the mortgage industry. There have been a lot of mortgage companies that have been combining with other mortgage companies that have gone out of business because there's so much stuff changing and shifting in the real estate industry. That's going to create a lot of opportunity for renters to enter into the market. While home prices might not be taking a dip like mortgage rates are starting to take a dip, inventory is starting to pick up a little bit. So you might see some more affordable housing coming on the market. But in any case, the best thing you can do is to make sure that you are prepared to take advantage of the opportunities that are coming in this market. So the 3 things that you can do to make sure that you are prepared to take advantage of this market that we're going into is by working on your credit, making sure that those credit cards are paid down, and making sure that you are saving money. Pay yourself first before you start paying the landlord and paying all these other bills that you have. Pay yourself first. Put that money aside in something that's going to be growing interest, growing your money, so that when you're ready to jump on one of these deals that's going to present themselves in the near future, you can do such and take advantage of it. So that's what I have for you. Thank you for taking the time to tune in. Please like and subscribe to the channel. Leave me a comment. Let me know what you think about some of these videos and some of the content that I'm putting out there, because I do want to continue to provide things that are going to be beneficial to you to help you along your home ownership journey as well. So thank you again for taking the time to tune in. Take care. Be blessed. We'll see you in the next episode.